Hello, and a very warm welcome to all our viewers back onto this weekend of February the 5th on Sunday. As we saw that the crude prices declined by almost 7% to close at 79.94 to the Brent. So it marked a very strong decline and which went against quite a bit of trend after the first week of January, where it has been continuously moving up for 3 weeks. Now, what are the key reasons behind this, and where do you think that this could lead to in terms of reversing the trend? Now, the China demand, which has been the hot topic for the analyst and the market to be looking at to fuel this rally. And as we have been maintaining on this channel for a fair bit of time, we do not anticipate China demand to be really making the kind of historical impact it has been making, not for the last 1 or 2 years, but for about 3 decades now. 2022 was the year when the China demand declined, and that decline came after more than 2 decades of continued growth. So much so that our readers are quite well aware that China has been accounting for 59% of the global oil demand growth. 59% of the global growth was contributed by China. And that marked a shift last year, 2022, when it declined. So what we are looking at, the recent increase after the first week of January in the China imports was largely to meet the export quotas for the refined products. And the export quotas are again dependent on the market scenario of Europe and the US, and as much the rest of the world. When we take a larger look, we remain quite bearish onto the China demand side. Let's look at the domestic consumption of China, which has been declining from November onwards, November, December, January as well. This is despite the lifting of the COVID lockdowns. So going forward, we continue to maintain that China is going to disappoint onto their domestic consumption, and in the result of that, their import of the crude as well. And when we look at the US and Europe, US demand of the refined products, mainly the gasoline and the diesel, is tapering. It's not declining, but it's not growing anywhere close to what it was forecast to. Matter of fact, November and December, they have been in decline in terms of the product demand. Europe as well, quite similar stories. So in sum, what we are seeing is a synchronized slowdown in the refined products consumption. When we say refined products, it's the product as against the crude. And we should bear in mind, crude is consumed by the refineries, while the product is consumed by the consumers. Now it is the consumer slowdown which is reflecting across Europe, US, and China to varying degrees. So that decline, we do not see getting offset. While onto the production side, there are largely no concerns. All production centers are free from any strife. So even the sanctioned countries like Venezuela, Iran, and Russia, of course, their product continue to move and continue to move fairly easy. So we do not see any uptick in the prices in the near term. Matter of fact, our call is that prices could be touching about $70 to a barrel for the Brent in about next 3 to 4 weeks time before it starts stabilizing and then maybe continue to inch further. So our current assessment onto the Brent oil is bearish, and it has significant potential to slide down to $70. Now we come to the next part of our episode, which is furnace oil and gas oil prices have fallen last week. And now with the impending EU embargo on the Russian refined products starting next week, which is now actually. So do we see a reversal of the trend? As we have seen, the products get rerouted when the sanction regime start taking place. And 2022 is a very strong example to that. Markets and the product find its way, and that's how the crude market works. So between Malaysia and the UAE, lots of product rerouting is happening. And what we see in the global trade data, that Malaysia is the source of the imports, which is significantly higher than Malaysia's own production. So whether it's UAE or Malaysia, the rerouting happens not only at these two places, at many other places. And the trade and the markets have a far better way to move around. And that's why we are seeing an oversupply of products and the impact on the prices. So we do not see this current product sanctions by the ER, by the European Union, having any noticeable impact. Something minor, yes, but it would largely be negligible. And with that, we come to the last question, which we take up for our larger full year view, which is the crude oil prices outlook for the whole of 2023. Now, 2022 was marked largely by the concern onto the supply side. And that's where all the spike, where the Brent went up to $140. And finally, the average price settled at about $100. Now we are seeing significant concern for 2023. And unlike 2022, which was largely marked by the supply side concerns, 2023, in our view, would be marked by demand side concerns. So demand would be the key theme, or the demand slowdown would be the key theme going into the 2023 for the whole year. And demand is not complete without looking at the supplies. And supplies, we see, is going to be more robust. As we have seen in the data trend from November onwards, markets are oversupplied. And we maintain a view that market would continue to be oversupplied, which brings us to the question as to when could be the next round of the cut from the OPEC plus, because if demand is going to be a concern and the market's oversupplied, so at what time does OPEC intervene? Our view is not in this first quarter, but second quarter onwards, yes, if the demand concern, as we foresee it, continue to build up, and which means demand continues to disappoint and the production remains robust. So April would be the time when the OPEC would be expected to take some further cuts in terms of their production quotas. The production quotas, how much that is going to really lead to the production cuts in the actual production, that is something we'll have to wait and see. And at this point, we would like to remind our viewers that the last OPEC production cut quotas, which were announced for 2 million barrels per day, the actual production cuts translated to about 700,000 barrels. So there is always a distinct gap between the quota, which is the target, and the production, which is the actual achievement. We'll need to wait and see. But overall, we believe that the crude prices would, on an average basis for 2023, would be below $80 per barrel mark to the Brent. This has to be compared against average prices of 2022, which was at $100 for the Brent. So our assessment is, at this stage going forward, this is going to be an year where demand concerns would come to the fore, which would keep the prices under check. So at about less than $80 to a barrel. But if we go back to 2018 and 19, oil producers and the oil consumers both should be very, very comfortable if the prices remain below $80. Thank you for tuning in. Thank you.